Let me ask you a question. If I give you R1 million today, would you know exactly what to do with that R1 million? I've been doing investments for close to 15 years, and most people don't have investment problems. They have jargon problems. They often feel overwhelmed and they feel that the complexities are getting them down when it gets to investments. Well, today I'm going to explain investing so simplistic that in the next few minutes, you'll know more than 90% of your peers and ordinary investments to start your investment portfolio with due diligence and confidence. So let's start with the most basic question. What is an investment? An investment is something you buy today that is expected to give you a return tomorrow. That return comes in two ways. The first option is yield. So this is income, interest, rent, and dividends. The second option is growth. So this is typically the value that increases over time. Now, there are 1 million of investment opportunities people talk about, and you'll hear this every day. Crypto, commodities, art, watches, gold, startup, techs, apps, and the list goes on, which is all good and amazing. But if you want to master the following 4 main asset classes, you will understand the entire game, and you will take ownership over your investment portfolio. So there's 4 main ones: equity, property, bonds, and cash. Let's break them down. So the first one, equity, is shares, business ownership. It's very simple. You're buying a piece of a business. So let me give you an example. If you buy equity in Steers, so let's say, for example, 30% equity in Steers, it means that you own 30% shares in Steers. So if Steers goes up or if the business goes up, automatically you also go up and you make more money. So equity value is directly derived on whether the company makes a profit. It is very important to understand that equity and businesses will always outperform the rest of the market. And the reason for this is because a business can recreate itself. It can run campaigns, it can market itself, it can study, read books, become better, outwit the competition, and over time, it will always outperform other asset classes. Equity is also usually the most volatile in the short run. People normally react to panic quite quickly. So if the markets go volatile or fluctuate, automatically that you'll see that in your portfolio. It's just that emotion, or it's just that personal emotion, that knee-jerk reaction that people normally react on. So it's very important to understand that time in the market beats timing the market. You got to invest through the ups and the downs in the market over the long run so that you can enjoy the recreation of businesses and the upside thereof. The second one is property. So property has several options as an investment. And this is where a lot of people get it wrong, because a lot of people think property is just bricks and mortar. Yes, there's the bricks and mortar, and there's a couple of options. There's actually a great book that I would recommend by Prosperity Enterprises, where it speaks about different options. The classic bricks and mortar where you buy, you rent it out, you buy, you flip the property, then you sell it for an upside. You can go and take a bond, then refinance, so you make some enhancements, refinance it against a bigger lending or mortgage, and then basically use whatever you've refinanced it for to buy something else where you get a bigger yield. Again, this is quite technical, and I would recommend that you either do a lot of study on this or speak with somebody that's got the expertise. And then also you have options where you can invest in real estate companies, of which, not that this is advice, but let's use an example like GrowthPoint. So this is typically a company that's got underlying investment or asset class exposure to properties. The benefit of this is if you invest in a company like GrowthPoint or in a company that invests in underlying property, you've got that professional team skill, expertise of running the portfolio. So you don't need to do all the due diligence, make sure that the location is right, make sure you've got you into the right structure, etc. And you've got that scale and diversification option. So you buy a portion of the company that gives you that global exposure or local exposure, and you still enjoy the full upside as a shareholder. The third option is where you can invest in commercial or real estate property. We've seen real estate property actually, yield some amazing returns. And this is with the rise of online platforms where you can buy online stuff. Amazon, Takealot, all of these companies, these online shopping companies, they need massive industrial properties. So we've seen some amazing growth in that space. And then the third one is bonds. Now bonds is boring, but boring isn't always underrated. A bond is basically where you're saying, You go to a government or you go to a company, a private institution, you lend money and you get a return for that money that you're lending, which we also refer to as a coupon. The easiest way to explain this is if you go buy your property, you buy your first house, on the other side of that transaction is a bank that is actually making money out of you. So that bank lends you the R1 million, but over time they make close to double that over a 20 or 30-year process. In South Africa, bonds are doing really well. We've seen our bond market actually outperforming very close to equity-like returns over the long run. And this is typically because our government and the local, especially emerging economies, they tend to give amazing yields on bonds because they want foreign investors to basically draw into the local market. A bond is a very stable, your risk there is default, people that can't afford it anymore. But if you manage your risk, a bond is a pretty stable investment. It will never shoot the lights out over the long run, but in the short run, short to medium term, it's actually a very nice stabilizer to include in your portfolio. And then the fourth one is cash. Cash is a parking bay. It is not something where you should try to invest your money. The issue there is, yes, you get safety, yes, you get accessibility, yes, you get stability, but your biggest problem with cash is over the long run, cash will lose to inflation. So inflation is, I buy water at 10 Rand, next year water is going to cost me 11 Rand. If I invest in cash and I invest 10 Rand, next year it's only going to be 10 Rand 50. So things are getting more expensive than what I am able to keep up when I'm investing purely in cash. So it is important to understand that cash will always do inflation or less. Your bond, property, and equity markets will typically outperform inflation over the long run. And depending on the investment philosophy, it will determine by which margin. Okay, so let's just talk a little bit about stability versus growth. Investment management is where you balance all these asset classes in one balanced portfolio. So you often hear the term, listen, we've got a balanced portfolio or an aggressive balance or a stable balanced portfolio. We're basically mixing up all the asset classes. And professional wealth managers and financial advisors can help, especially if you don't know what you're doing. If you, for example, want a balanced portfolio with a little bit more stability, you'll see if you look at the asset allocation and the exposure, it's got more exposure to cash and bonds. If you want something with a little bit more long-term growth, something that, like more like an aggressive balanced portfolio or an assertive balanced portfolio, you'll see it's got much more weighting on equity and property. And the nice thing is you can also blend this between local and offshore. So for example, you can have local equity and offshore equity, or you can have local property and offshore property. Very important to understand what is the strategy local and what is the strategy offshore, because certain asset classes might perform much differently in foreign markets than what it does locally. So the balancing act is what is important. And I think over time, if you invest little by little, you will start building your entire portfolio, which is a massive balanced portfolio of all these different asset classes that you've got in. Now, the next question that we quite often ask is, Stefan, I understand asset classes. I understand equity, I understand property, etc. But where do I invest this in? First of all, it's important to understand that we want to invest everything on a platform, of which a few, Alan Gray, 91, Glacier, PPS, all these different platforms are available out there. The reason you want to invest on a platform and not necessarily always directly is because of regulation. Platforms are regulated, so you know it's safe. You know you won't be taking a run for your money. You won't buy into something where everything will crash and plummet. All of this is regulated by FSCA. And on these platforms, you get different investment vehicles that one can invest in. And a lot of people confuse asset class with investment vehicle. A lot of people ask me, Stefan, will a retirement annuity, that's one of our first investment vehicles, will that perform better than a tax-free saving? So let's quickly talk about that. Asset classes are almost like your engine and your fuel, whereas a vehicle is something that will carry you. That's where you invest in to carry you over the long run. So investment in vehicles include retirement annuities, tax-free savings, endowments, unit trusts. Those are all different vehicles that you can fill up with different asset classes. So the question isn't which investment vehicle I should be buying. It's which investment vehicle I should be buying and what underlying engine or asset classes is in that investment vehicle. If we've got two investment vehicles with the exact same asset classes, retirement annuity and a tax-free saving, same asset classes, they will perform exactly the same. There is no difference. Now, the follow-up question is, but what is the difference between the investment vehicles? And that difference is just the legislation. It's the accessibility, it's the tax, it's the framework around that investment vehicle that makes it different. And the 5 main asset vehicles that is available in South Africa. And yes, again, there is more, but the 5 I want to focus on, which most people deal with, is the following. The first one is a normal savings account money market that you've got with your bank. These are very stable. It's cash-like. It's great for emergency funds. It's great for goals for the next 3 to 12 months, but it's not great for building wealth. It will never shoot the lights out over the long run. Again, because you're heavily invested in cash, it's typically inflation-linked. The second one is an open investment, a unit trust, discretionary investments, whatever you want to call it. It is a flexible investment that gives you access to that investment. This is typically a little bit lower when it gets to tax, but it's still heavily taxed. You can invest in bonds, property, offshore, equity, local, 100% offshore, 100% local. You decide. Typically, it takes about 3 to 5 business days to access that money, but it's a straightforward open investment unit trust. The third one is a tax-free saving. Now, this is one of the best long-term tools that you can invest in. The returns grow 100% free from tax. It grows 100% free from dividend withholding. It grows 100% free from capital gains tax. The biggest issue is a lot of people don't utilize the growth opportunities in there. You can only invest 36,000 Rand per year and $500,000 over your lifetime. If you don't invest that in growing vehicles, you're losing out on that time value of money. You're losing out on the opportunity to grow over the long run. And then the fourth one, endowment. So this is a structured investment policy. This is where it is wrapped. All the taxes, everything is wrapped in the fund. We also refer to this as a life wrapper. It is a little bit less flexible. You normally only access this money after 5 years. But the nice thing is that you are taxed at a flat rate of 30% within the fund. So typically high earners, 45%, 40% plus, you score at least 15%. On capital gains tax, you score about 6%, from 18% to a 12% effective tax rate. And then the last one is our retirement vehicles. These are normally the most tax beneficial vehicles that is out there. For example, every 1 Rand you invest in a retirement annuity, you reduce your taxable income by. Every 1 Rand you invest in a retirement annuity, if you're on a 45% tax bracket, SARS will give you 45 cents back as a tax benefit. All the income, all the growth, all the yield, everything within the fund is 100% exempt from local taxes. The moment you pass away, that doesn't form part of your estate. So there's a lot of technical tax benefits. But the issue is you can only access this money at the age of 55 and onwards. So the rule of thumb currently in South Africa is the more accessible an investment tends to be, the less tax efficient it is. And the longer you are locked in, for example, an endowment, 5 years, retirement annuity, age 55, the more tax beneficial it becomes. SARS kind of rewards you for being a long-term investment. So you always have that trade-off, whether it's flexible now or whether it's tax efficiency later. So let's just put this all together in an example. Because I do get a lot of clients asking me, Stefan, I'm planning to put down a deposit on a property in 2 years, or I'm planning to go away to Mauritius next year. That time frame is literally below 3 years, 3 to 5 years. It's shorter than that. I would say look at an investment vehicle where you've got access. You don't want a property deposit in 2 years that is fixed up in a retirement annuity. So that should be in something that is accessible. And put it in something that's a little bit more stable. So if you look at a balanced portfolio, heavy cash, heavy bonds, potentially a little bit of equity that gives you that bit of upside so that you can just outperform the market. And then again, if you're investing for 10 years, 20 years, 30 years, child's education, maybe retirement, maybe you want to start a practice in 15 years, whatever the case might be, that should then be in something like an endowment, maybe a tax-free savings, something that will stir that long-term growth in a tax-efficient way. You don't want to lose all the growth that you've accumulated over 10 years in taxes. So your defensive goals, short-term, you need defensive assets, so cash, bonds, etc., but with accessible vehicles, unit trust, open investment, money market, etc. Your long-term goals, you want growth assets, equity, mainly equity, and then also some specialized property with tax-efficient vehicles. So what is the strategy from here? You've got all this information, you understand asset classes, you understand vehicles. What is best practice is you need to sit down and you need to do a risk assessment to understand what is your risk willingness and your risk capacity. Willingness is what you can stomach. You might be somebody that's risk averse, or you might be somebody that likes risk. Risk capacity is how long you have in the market. If you are 54 years old and you want to retire at 55, you don't have a lot of time in the market, so you don't have the capacity. But if you're 19 years old, you've got the capacity, so you can invest in something that's a little bit more volatile. And you must respect both. You must create harmony and synergy between both, willingness as well as your capacity. The second thing you need to look at is, what is your budget? You need to look at your cash flow. What can you trim down? Maybe print 2-3 months of your bank statements. Go look through, look at some of the stuff. Which fat can you cut? How can you cut all the debt weight and trim and create a bit of extra cash flow? Warren Buffett says it best. He says you should first save and then spend. But a lot of people spend and then try to save whatever is left. And lastly, look at your tax benefits. You need to try and optimize all your tax benefits. If you are in South Africa currently, by the time this video is shot, you have 36,000 Rand that you can invest in a tax-free saving. Your wife, your husband has 36, children 36. You can do 500,000 over your lifespan. It grows all free from taxes. If you're a 45% owner, don't invest all your money in money markets, cash deposits, because that's interest taxed at 45%. Go look at maybe an endowment structure where capital gains tax is taxed at 12%. There's a lot of benefit and a lot of upside in just being more tax efficient. If you've got two investors, same amount of money, but one is more tax efficient, obviously over the long run, this one will win. Wealth creation is not about finding the perfect investment. That is an anomaly. That is 1 in a billion, where someone invested into something and it blew up. Wealth creation is little by little. It's choosing the right investment vehicle, starting small, creating discipline, understanding what you're investing in, using expertise. A lot of people try to do it themselves. Use expertise where expertise is required. Match it to your time horizon. Stay disciplined, especially when emotion hits. So when the markets are volatile, you want to change, you want to chop, and you want to make sure that invest through a market. Try to invest in a strategy. Try to invest into something that you think over the next 10 or 15 or 20 years, it will add value. And I want to also encourage you, if you found value in this video, I want you to hit that subscribe button, share this maybe with some of your friends. You've been thinking about investing, you're not 100% sure where to start. Watch this video, go through the basics and make sure that you understand the underlying portfolio. Our goal is simple. As Money and Medicine, we want to educate, edify, empower, enlighten medical professionals to make better decisions. We want to be the most trusted platform in the world when it gets to this if you're a medical doctor. So watch some of our other content, share this with friends, hit that subscribe button, and until next time, plan the plan.